Nothing? All right, looks good and sounds good. Fantastic. All right. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risk and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold you above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. So that's where we are. It's a very nothing day. We're drifting. Still, we're doing a lot better than we were last year, because last year, when we had the State of the Union, do I have a thing for that? Here you go. Let's go. DJI. So let's do a 3-month view, and we'll go back to last January. Oh, that's weird. It's got momentum when you do that. So here we are. Here's the day Trump gave his State of the Union speech, January 28th. Wait, not 28th, sorry. Oh, no, I'm sorry, it's the 30th. I apologize. It would have been Tuesday, the 30th. So here's the day he gave his speech, his State of the Union speech. And here's what happened. Well, actually, it's interesting. It's the next day. On the next day, we drifted. All seemed fine. And then all of a sudden, massive cliff dive. That is wait a minute, that can't have happened that quickly. 2122. 26,000 to 24,300. Are you kidding me? That's like 2,000 points. I don't remember that. I don't remember being that bad. I don't know. It was pretty bad. Anyway, so we have that to look forward to. Look, my working negative theory is that all this coming to the State of the Union was bullshit to prop up the market so he could sit here and say, look how great everything's going. And he did. He spent a lot of the State of the Union address talking about how great the market was and how that proved he's the greatest president ever and blah, 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 blah. Now, of course, we're not at 26,000 anymore. But when did he give a speech? 129, 130. All right. So here he's at 26,100, and currently we're at 25,100. So we're about 1,000 points down, which is 5%. But we fell all the way down here. I mean, it was a massive, massive drop. So hopefully that's not what happened again. But it bothers me because if we look at the current month, okay, it's the same stuff. Very low volume, propped up sort of rally. And we know that, you know, Trump said this about China and they promised this, and then Powell said this and that, whatever it takes to prop up the market. But we are up 3,000 points in a month on nothing, on no particular good reason. I mean, some earnings have been decent, but I mean, not, you know, they better be decent at these levels. You know, and I say that when we have the red books, the beige books, the red books, the beige book reports. You read it differently when you're in a record high market than you do when you're in an average market. So if you're at record highs and they say things are good, things are okay, things are, same as last time, no problem seen. That's not a record high kind of report. A record high report should be amazing, huge numbers, fantastic deal, fantastic performance, lots, huge tourism. You should be hearing superlatives all the time in the beige book. Otherwise, why are we at record highs? If you're at record highs and the beige book people are saying, yeah, pretty good, yeah, it's kind of nice. That's not really, then you got to say one of these guys is wrong. Either the beige book people are wrong, and those are the feet on the ground guys who are the actual manufacturers. Actually, what the beige book is the Fed talks to all their buddies, all the Fed chiefs, talk to their local manufacturers and local retailers, and all the heads of all the companies, all their friends, basically, all the people who are big shots in their region. They talk to those guys and say, how's it going? It's all anecdotal. And they just write down notes about how it's going. And then they get summarized and then the staff will follow up and ask some additional questions or whatever. But the bottom line is, it's really just saying, how's your business? It's like, hey, Fred, how's business? Good. Oh, okay, good. I'll write that down. I mean, that's the beige book. But again, where's great? It's gotta be great. If the market's at a record high, when you call Fred, he should say business is great. And if you don't get that, you got to say there's a discrepancy somewhere, and the discrepancy is usually in the market because the market's not that great at telling you what's going on. The market is a indicator, usually a lagging indicator. It's not a leading indicator. It's a lot of bullshit. It's usually a lagging indicator of how the economy is doing. So if the economy is doing great, the market should be doing great. If the market's doing crap, if the economy is doing crappy, sooner or later the market's going to reflect that. Nobody's saying it's crappy, but nobody's saying it's great either. And that makes you question why we at record highs, why aren't we sort of more in the middle? And the middle is not here. Here, yeah, here we go. The middle, if we look at the S&P, and we look at a monthly chart, the middle is not up here. The middle is probably about here, about 2250, 2000, maybe a bit low. But let's remember, we were at 1500. All right. So in the 2000 crash, we were at 1500. Then we went to 1000 or less than 1000. Then we go back to 1500. Then we have another crash. So after this crash, during a decent economy. It wasn't great. It was the Bush economy. He did tax cuts, just like Trump. And he started a couple of wars and things like that. But it was stimulating. And he actually gave people money at some point to keep the economy going. But we all collapsed because a lot of it was artificial. What happened? And we came back down. Then we come back. This took 6 years. Here we are taking 6 years goes out to here. We actually recovered. Now in this case, we recovered much higher than we did before. But then, for no apparent reason, we've gone up another, not just one notch, but 2 notches higher. And you got to believe that the market's getting ahead of itself somehow, right? This is double where we were here. But you can go to any of these earnings reports. Nobody's making double. No, that's out the wall. I mean, people are making 20%, 30%, 40% more. Nobody's making double what they were at the highs. That's just not happening. So this is wrong. And what is happening though is the multiples are higher, and also there's way less stock. There used to be, there needs to be like 9,000 different stocks back here, 9,000 listed stocks. Now there's, I think not even 6,000, now it's like 5,000 listed stocks. So there's way less stocks, but the same amount of money goes into the market so that it's distributed to far fewer companies. There's less, each company's bought back their own stock, so they've got less shares outstanding. that causes the markets to be priced higher. So the PE ratios get higher just because it's supply and demand. There's more demand for stocks. There's more money chasing after stocks than there are stocks to put money into. So the stocks that are there get overpriced. That's not something you short because that's a fact. You know, it's like going to art auctions and shorting paintings. You can't short the paintings. They keep going up. Nothing's going to change unless something changes, unless a big flood of Rembrandts are discovered or something like that, and all of a sudden there's a lot more masterpieces to sell than there used to be, which doesn't happen. Then they're always going to be expensive because there's always more rich people who want to buy a painting than there are paintings for rich people to buy. That was the entire point of these auctions. They tease and entice, and they do everything they can to get the world's richest people to go to these events, because those people on a whim can spend $100 million. You know, they'll sit there and bid on things. You know, who else is going to do that? That's why they only have like once or twice a year each auction house, because they can't oversaturate the market. Because once a guy buys $100 million painting, it's usually done for the year. Hopefully that's enough. Not Bezos, so he can buy one a week. Anyway, so we're back in that sort of like a little too high zone, and makes it tough. So everybody looks like we should recover. Why should we recover if this was the wrong price? Why would you recover to the wrong price? It's like if your engine was overheating in your car and it cools back down, and then you put the coolant in that you ran out of coolant or whatever, and the engine overheated, and then it cools back down, and then you start it up again, but this time you have coolant in it, so it's running normally. It runs back to this temperature, not to that temperature. And you don't watch the needle saying we should get back to that temperature anytime now. It's not supposed to be there. It never was supposed to be there. It was an accident. It was a bad situation of circumstances. It doesn't mean that it should be there. It just was there. Just like it was minus 40, in Massachusetts the other day, and that doesn't mean today it's like 45, and it doesn't mean my daughter's waiting for it to get back to minus 40. That's not normal. Something abnormal happened. This is abnormal. Running up. I mean, look at this range. You're in a range of 500 points for, and I don't know how far back it goes. This is as far back as this thing goes. Well, I guess we can find out. Let's find out. Let's be professional and find out. Here we go. What the hell? Oh, I did the wrong thing. Oh, there's GSPC. Max. What? Oh. All right, so what was that range? What's this? Oh, look how far back it goes. All right, so really, well, it did start around here. It started in 1999. So when we did pop, so that's actually good. It's a good snapshot. So this is where it started. So we came up in 1999. We were in this range from 1999 until 2013. So 14 years in that range. So it took 14 years for the market to really push up 500 points. But let's not say 500 points. Let's say it doubled over 14 years. I'm sorry, not double, went up 50%. Nice math. All right, so it took 15 years for the stocks to appreciate 50%. Now, in 6 years, they're doubling. 50% here. It's extremely unlikely. There's nothing to justify that kind of explosion in valuation. So that's really what my issue is with the market right now, is that this still isn't the right price. That we should have had a little bit of a better, it would have been a lot better if we corrected to here, although that would have freaked people out, but if we would have corrected to here and drifted back around here in the top end of this range, I feel a lot better about the market than I do now. Still iffy. Questions? Brian seems happy about NAK. We'll see what NAK is doing. And then we'll find out why it's doing. NAK is one of my little penny stocks. I don't like penny stocks, but I like this one. I'm like, oh, yo, look at that. And I was just gonna say, my kids own a lot of it. My kids are big NAK miners. Yeah, because look, NAK has been held back for many, many years because they can't get approval to drill. Not to drill, I'm sorry, strip mine Alaska. They want to strip mine. They have the rights to the world's largest deposit of gold and also molybdenum or whatever you said, which is very good, and copper, tons of copper too. Nobody cares about copper, it's copper everywhere. But you know, the world's largest mine of gold. But to get it, they basically have to rip a bunch of mountains apart and tear down the land and strip mine everything, and you know, just turn the Alaskan forest into a giant, you know, mud pit. They say they'll fix it later. Also, the big issue though is the mining waste, and look, usually that doesn't bother the government, especially the Trump government. But in this case, you have the salmon fishermen up there are suing because they say there is no freaking way where this mine is situated that they can control the runoff of all the waste materials, that it won't leach into the water supply and poison the salmon. So basically they're saying, look, you're going to approve this mine and you're going to wipe out an existing multi-billion-dollar salmon industry in order to just, you know, to open up another gold mine. So that's what's been holding it up this whole time. Now, you know, the EPA being what it is, we still expect it to get approved. So I figure eventually they'll get approved. It hasn't happened yet, but we'll see. NAK has taken on several partners, and they've always, and they're smart because what NAK does is they take on a partner saying the same thing I just said. They say, look, we never get approved, but you know, we own these rights and we'll split it with you if you give us $300 million for 5 years. It's your option to come in. So the money that NAK keeps getting, it's not diluting the stock. It basically is just cash that they use for operations, and it's an option for the person to become a 50% partner. So, you know, as an NAK holder, you're resigned to ending up owning 15% of whatever gets mined, because eventually they'll end up with a partner to do it because they don't have the money. They don't have billions and billions of dollars to start mining, but it's their mine. So we will see. But what here you have the base shelf prospectus. Shelf registration, I think they are selling some more shares though. Doing warrants, private placement, So it looks like they are raising some cash here, but in a way that people like it. Here's why he was 55% in November. Here's why they're 15% today. Here you go. Right-of-way agreement secures site access for Pebble project developers. I saw this a while ago. They've gotten security. They've gotten access to about 1/3 of what they want. They've been granted some access, so they're going to be able to start mining. And since that time, the stock is started to take off. You know, we had a big punch up here, and then it fell back down. Then we had a big punch up here, and I think probably we're going to be back in the twos. So it's nice. I mean, it's really nice considering, you know, it was in the 40s not long ago. And this can easily, if they start really mining down the road, though, this thing can go into $10, $20 range. So it's still in its infancy at $1. And I think we have it. I don't know what portfolio we have it in, but we have it in one of our portfolios. Let's see if I can fix this. Good God, that long-term portfolio's got a lot of positions. Holy crap. That's the problem with a good market is we don't have much reason to sell anything. Don't pay attention. These amounts probably aren't right because we haven't done our adjustments yet for all the new trades that we decided to make. They're not yet reflected in here. I've been busy. NAK. Nope, not in that portfolio. It must be the OOP. There they are. So we have not a lot. We have 10,000 shares, and we paid $1.40 for them. We didn't buy very smart, but we sold the $2 puts for 95. So we're targeting $2 in 2020, and we netted in for 140 minus 95. We netted in for 55 cents. So if all goes well at $2, we'll make about $15,000. So currently this trade is down that much, and I still like it. Still a good trade. The net now, in fact, is a credit. Well, that's why we're losing money. The net now is currently a credit of 20 cents, basically. And I still think the target's fine. I think that by the end of the year, we should be at $2 as they begin to move forward with the project. So that's been seen. That was a big loser. Obviously, at 40 cents, it was looking very bad. So now it's improving nicely, but that's not why our portfolio is up that much. Interesting. I don't see any bad entries. This isn't far off from where we are. Crazy as that is, we're up a ridiculous amount of money. Oh well, what can you do? Let's see. We're not up that much. We cannot be up 200%. That doesn't make any sense. Something in here is wrong. I don't know what, but I'll figure it out. It's possible something expired or something. If we were short something like January calls somewhere. I don't know. I'll find it later. But meanwhile, in other words, we haven't taken off the January calls that were short. If there were any, we haven't added in the new trades. But I find it impossible to believe that we're up that much. So that would be silly. It'd be nice, but it's silly. I mean, 200% is ridiculous. I was just saying this is our conservative portfolio, but it is outperforming the long-term portfolio. I say conservative, but it's like we do take more short-term chances in the options opportunity portfolio than we do in the LTP. But in the LTP, we'll do things like, buy an uncovered spread. I buy calls and not buy short and not sell short calls because we can afford it. We can afford to adjust and we can afford to do things that we keep. In the OOP, taking a hit on something is tough. It sets us back. So we prefer to play a little bit more cautiously in the options opportunity portfolio. The short-term portfolio, how are they holding up? See, that's still up. And again, I'm dubious as to whether we really gained 100% recently, but it's still up significantly high. Oh yeah, see, like Celgene is zeroed out for some reason. Actually, probably this would be in our favor though if it wasn't. So Celgene for some reason is pulling up all zeros and it shouldn't be. Don't see anything else particularly messed up. Microsoft. Oh, actually, I think we hit that one. Microsoft, we had puts. January short puts. I'm sure they were over. But then the short calls. One of them had to be hit. Where was Microsoft in January? So those, that's what I mean by not doing that. I have to physically get in there and punch in the numbers for where everything ended up. Microsoft, January, well, the 115 calls were worthless, but then the 115 puts we would have paid some money to. And I don't know if we rolled them or what. I mean, I don't even remember what we did. Let's see. Oh, what's this? Is this a review? No, that's a Money Talk review. Here's that route. Okay, so where were we? Oh yes, I was wondering what I said we should do with Microsoft. Microsoft will come back eventually, so we'll roll them along, but that's not Oh, that is what I was talking about. Okay. Oh, I guess I was talking about the short puts. Okay. Well, that wasn't very instructional. I feel bad about that. Microsoft will come back eventually, so we'll roll them along. But I should have said what to roll them to, and I didn't. Well, I mean, logically, just any other month just to roll the 115 call. So in other words, we're not going to pay the short call. We're just going to roll it and sell more short calls. And we expect Microsoft to start moving higher at some point. And that makes us want to look at their chart and see what I was talking about. Yeah, I think they're underpriced. In fact, that's interesting. Why don't we take a closer look at Microsoft? Because Microsoft might be a good buy at this level. I was worried about their PE, but they are growing sales. And let's take a look at where they are. They pay a teeny dividend, so that's not really important. It's so what do you get for $800 million or $815 billion? Sorry. You're getting some pretty good growing revenues. Not here, a little misstep there, but 91, 96, that's 5% higher, 6% higher, 96 to 110, 4% higher. Earnings erratic. They had a down year here. So 16 billion. Here's the thing though. What do we say? 814? 814 divided by 16 is 50 times earnings. Wow. That's a lot. But 814 divided by 25 is 32 times earnings. No, that's why I didn't buy Microsoft. Okay, sorry, my mistake. Now I know why I didn't go with them. Oh, I see. But here, and that's why I decided, see, that's why I looked at them though. So that recently though, you're talking about $30 billion in earnings. Now, if we do 814 divided by 30, that's 27 times earnings. Still a lot, but the growth is got to be taken into account. I mean, they are dropping a lot of money. If you look at 18 as being 30 billion, why is this number here? Oh, because they ended their year in June. That's why. So they ended the year in June, and now they're on a track for 30. So they're basically what you'd say back on track, +8, +5, bad year, and this year they're looking towards $30 billion. They're running up earnings 20% a year. So if you end them for the long term, they're not bad. So I think they will grow into their valuation, but I don't think they're hugely exciting at this price. But they're interesting. When they were 93, I think I was looking at it saying I wanted to pick some up, and then it jumped real fast. But at this price now at 105, they'll probably drift along this line for a while, and we'll see what happens. But I wouldn't say immediate action. But roll wise, if you have the January short calls, not the calls, it's the puts, right? Because it wouldn't be the calls that we rolled along. On January, whatever, they were about 107. So if they're at 107 and our position is here, then it's the puts that we're in trouble. The short calls expired worthless. The short puts, well, that's an easy decision for me then. Those January short puts go out to the 2020s or the 2021 short puts. So we're not going to pay them $8, and that would be a loss of about $3 there. So that's in our favor. That's why I want to say that I didn't think that was realistic. So that's in our favor that we didn't make $21,000. We actually lost 3 times 40 is 12,000. So it's $30,000 difference on that one. So once I put in what we did, it's not going to look as pretty. So rolling the puts along with each of the next year. Rolling puts is, rolling calls sometimes we do shorter, but rolling puts is always going to be some next year or 2 years out. And if we look at Microsoft and we have to roll this $7 puts, whoops, that's not Microsoft. So the 2020s What do we get for $7 is the question. So we can go to the 100s in 2020, or we can go to well, $7, you can go all the way down to the 90s in 2021. Now the question is though, do we and if you roll to anything out there, it wouldn't matter. But the question is really, say, do you want to roll for even to the 720s, and that means you're still netting in the $5 you sold, or I think it's $8, so you have to roll to like the 92.50s, whatever. But you're still netting in the $5 you originally sold at this position, or do you want to go to these guys, 100s for 11, pick up $3 on the roll? And now you've sold it for the 5 you originally sold for, plus the 3 you make on the roll is $8, and really you're into Microsoft for $92. So that would be my roll. Because I do think they'll come back. I think that given 2 years, they'll be at $35–40 billion, getting your Apple's kind of earnings, and that's a lot of money. And so they should get a $1 trillion valuation out of that. That they will deserve it. So I think that. Given 2 years, I don't have a problem having the short 100s. So that's where we are. That's also, but the other thing is for the OOP, it's kind of margin intensive. So, because that was a leftover from a successful bullish play we've done. Maybe you want to cut it back. Yeah, I would say, if these guys are 11, in fact, you know what? These are 13, the 105s. I would roll to the 105s at 13, but since 13 is more than, you can probably do almost 50% less. So if we had 40 at 8, that's $32,000. And here at 12, we could do 20 for 24, or maybe 30, or maybe 30 for 30 for 36, 30 for 39, 25. All right, so let's say 25. So we can roll from 40 shorts to 25 shorts and cut a lot of margin requirement. And that's probably worthwhile. So anyway, like I said, anything, if you've done it already, fine, it doesn't matter. Obviously, you have to do something. Theoretically, we took the loss, and now we got to start from scratch because we never called an official play. So we took that loss of $3, and now we're going to have to say, what should we sell? So officially, I would say I would sell 20. I would sell 25 of the 105 puts and just see how that rides out. So we're going from 40 to 25, but sticking with the same strike. Nobody has any questions. Okay, good. What else is going on? What's exciting? What are we doing in chat today? Don't think we made any major calls, but let's see what we were talking about. We're talking about Russell 1525 being critical juncture, and the Russell is at see, it's very easy to predict things using the 5% rule. We dropped out at 1525 here, we spiked up to 1525 here. That's 2 fails up here, and now we're kind of trying to get back up to that line. That's going to be a tough line to cross, though, that 1525 line. And the NYSE is the other one. I'm not sure where they are right now, but that's the other one we got to watch closely. But if we're going to have a rally from here, we got to get over that line. That's really important. Everybody else is doing okay. And the natural gas cannot get over this line. Natural gas keeps failing right here. It's a shame. All right, so we talked about that. It was important. Oh, here's the NYSE. See how it's not updated, but it's let's see. Now it's at 12.4. So it needs to get to it's actually down a little bit today, so it needs to get to 12.5. So we'll wait and see if that happens. All the nonsense from Trump. That was a weird thing he said at the end, though, that he was talking about, like, he's like, this economy's going, oh yeah, an economic miracle is taking place in the United States, and the only thing that can stop it are foolish wars, politics, or, and of course he emphasizes, ridiculous partisan investigations. If there's going to be peace and legislation, there cannot be war and investigation. It doesn't work that way. Okay, first of all, you're the guy who's starting a war if there's going to be a war, and I don't even know who we would be. I don't even know who we're going to war with. It's like he's saying you can't start a war. What war? We don't have a war. We're pulling out of Afghanistan or whatever, but we don't really have a war other than the ones that we started like years ago. So we're not starting wars. So he's really talking about the legislation and investigation, and he's saying, I think he's sort of threatening he'll start a war if we keep investigating him. I think that's what the threat is, aside from obviously that he'll cause massive disruptions and so on and so forth. But he's threatening the House. That's what he's doing. He's sitting there in Congress threatening the House that he's willing to wreck the economy if they keep investigating him. It's not going to stop. Pelosi just said today, we're not investigating because you say the economy is going to suffer. It's like, the United States is suffering if you're a Russian agent. So we're going to find out what the hell's going on. It's crazy, though. It really is. It's mad stuff. So we'll see what happens. I'm not predicting anything because I don't know what's going to go on if they have enough evidence. And if they don't have enough evidence, they'll serve out 2 years, and then the voters will figure out what they want to do with them. Hopefully, unless they declare martial law or something like that. Anyway, all the indexes are improving, all very nice. And what did we talk about? We talked about wheat and precious metals. We talked about SDS as a hedge. This is a good note about SDS, using SDS as a hedge and how to use it. Talked about shorting at 25.3 and 15.20. We got a little bit of a dip, but nothing exciting. So, it wasn't great money or anything. It's just like some quick little extra money here. The news was, let's keep this up. Let's keep this in mind that in France, they're still protesting. There's still riots going on. They want to put up the solution Macron has is to put an anti-riot bill in so that they can crack down on the protesters, not to fix the problems or address the issue, but to crack down harder on protesters. This is how you end up making a mess of things. LA has an outbreak of flea typhus. That's bad. I have to go to LA in March, so I hope they figure it out by then. This is, again, my concern from yesterday. Stocks are soaring, but bonds, bullion, and the dollar aren't acting like the stock market is soaring. So they're basically indicating this is bullshit, this rally. The Fed is including high unemployment in the 2019 stress test scenario. That's odd if they think it's so great. Why would you be worried about high unemployment in 2019? That's a little odd. Oil, blah, blah. OPEC, this is a big deal. Where is it? Oh, that's not the thing I meant. OPEC is trying to formalize their agreement with Russia to include Russia in OPEC. That's puts a lot more oil under their control. So we'll see how that works out. Goldman is cutting back commodities. That means there'll be less fooling around with commodities. That'll be nice for us because they're a big pain in the ass the way they manipulate it. It's a real nasty article about the Model 3s and how poor quality they are in Tesla. The drug thing, we tried that yesterday. LABD, was it? I don't think anything happened though, because Trump did come out and say LABD was the drug thing. Yeah, that's a bearish biotech, and it actually went lower. And I guess it's probably because Trump didn't have any kind of specifics about reforming policy. So this little bold call spread we took doesn't look like it's going to do so well. We thought it would go up because this is an ultra short on the biotech sector, which isn't directly pharma, but it's a good proxy. And Trump was talking about controlling prices and how everyone agrees on that, but I don't think anybody thinks the legislation is going to pass. So that's where we are on that one. Apple's retail chief is leaving. Disney kicked ass. That's a stock we have somewhere. Where's our Disney's? Not in this portfolio. Long-term portfolio. A lot of times our targets are so conservative, it's not even worth, wondering about. Control F, DIS. Yeah, look at that. That's kick-ass, right? So we're oh yeah, we have a pretty good target though. We're targeting 140. Wow, that's pretty aggressive. I look at these things sometimes. I'm like, wow, I'm pretty bullish. I didn't know I was so bullish. Now, hang on. Did we make an adjustment on Disney? I think I would have because I like Disney and they were cheap. So I wonder what I said. No, Disney. There we go. Disney. Oh, let's sell 5 April 115 puts and 5 April 115 calls. So we have 4,500 with $9 in wiggle room, but we did not apparently, we didn't actually improve the position. And that's in, that's in the butterfly portfolio. That's why. Okay, so in the butterfly portfolio, we already were bullish because we have the 92-110 bull call spread. That's where we're conservative. And we sold the 115 puts and calls. So we're good on that. Now, that's not the big one I was thinking of. Here it is. Oh, see, I knew it. We did an aggressive roll. The 25, 2021. So what I was saying is that these 2021 120 calls, we rolled them down to the 110s at 1350. So these, we rolled down to the 110s. We widened the spread. And that means that as Disney climbs, we make a lot more money. And that was a little while ago. That was weeks ago, actually. So that should be doing very nicely. Oh. It's a very tiny keyboard I have here, and I'm in a funny position when I'm doing it, so I come up with a lot of typos. So we actually haven't moved, but we have that really big spike down, and then we started recovering. So we should come back to the 120s, and we have a very wide spread now. So if Disney does well over the next year, we're going to do fantastically. But I feel like I like that spread, and it's already in the money. So what's not to like, right? I mean, you got 11 plus 8 plus 5 is 19, almost 20, 25,000, I'd say. Minus 15,000, so you're plus 10,000 so far. And but we've widened this part of the spread. But even so, even at this size, it was still a $50,000 spread. So it could be quite a lot of money in the end. And again, that's like the bread and butter of what we do. I mean, we take a value stock, and if it doesn't perform right away, we don't get out of it. We improve the position. We started off selling a put, a $95 put. That obviously never had much problem. Then Disney came back down in October on the 19th. Or were they October 19th? So somewhere around here, we jumped into the bull call spread. We decided that this was fair money after I think they dipped on there from at 118. They came back a bit. We jumped back in. Oh, October. Yeah, right around here as it was falling. Could have been, where's the 22 line? Oh, no, I take that back. I think it was right here, actually. All right, it's more like here. But anyways, we added the bull call spread. But, fortunately, because we sold the premium, it worked out. We already had the put, so we didn't have to worry about that. And as it fell, our decision was to widen the spread. Take advantage of the fall, not get out, not say, oh my God, this isn't working. We said there's nothing different about Disney. Nothing changed. So I don't care that it sells off with the market and drops 13, 15%, whatever. That's not important. The whole market's down 20% and Disney's down 15%. I'm not going to freak out and sell Disney. I'm going to take advantage of the drop and buy more Disney, or in this case, just improve the position I already have. So for $5 or less than $5, we rolled to the $10 lower call. We bought $10 for $5. That's what you can do when the market is on sale if you have the cash and the margin to make those kind of trades. And that's why you should always have the cash and the margin to make those kind of trades. Rich says, for hedges, 2-euro hedges, when the long call price falls below the spread cost, I think the situation makes 2020. All right, I think the question is for hedges, do you roll hedges when the long call price falls below the spread cost? And the answer is generally yes. So in other words, like with SDS we were talking about, let's look at that for a minute. No, that's not the right place. SDS. Okay, so if I'm looking at SDS, and we were talking about the June calls in this case. So SDS is at 36, and if it's a 2 times ETF, so it's going to move 1.2 times 36 if the S&P falls 10%. There's an inverse ETF. So if the S&P falls 10%, SDS goes up 20%. Now, it doesn't exactly go up 20%, but somewhere in the neighborhood. So 43 becomes our target. So to protect ourselves from 10% drop in the S&P, we expect SDS to hit 43. So from there, I know that this is going to be generally the top of my range. And then I look for where I want to be in my lower calls. So ideally, I'd like to be in the money. So 35. So the first place I'm going to look is like 34, 35. So now I start looking, same thing. It's the same rolling concept though. If this is 290 and this is 240, 45, all right, 295, 245. It costs me 50 cents to roll down $1. I should pay that. Okay. If this is 45 and this is 50, what? Wait. That doesn't make any sense. If this is 345 and this is between 3 and this is 390 something, again, I'm only paying 50 cents to roll down $1. I should do that. If this is 390 and this is 460, now it costs me 80 cents to roll down, 70 cents to roll down $1. So I'm going to stop there. And this morning I think we hit 32. But I'm going to stop there. I'm going to stop when it's no longer worth it for me to roll to the next one. I always want to buy $1 for 50 cents. All right, so once I kind of have a range, I say, well, where do I want to be? I want to be as low as I can be. I want to pay the least premium I can. The lower I am, the less premium I'm paying. At 33, I'm paying $4, so I'm paying 37, and they're at 36, so I'm paying $1 in premium. But I can erase that by selling something for $1. But what's my target? My target's 43. I'm at 33. So 43 would be a $10 spread. And how much more do I get paid for selling the 42s? I get paid nothing. I get paid 20 cents maybe for that. I get paid from here to there. I get paid another 20 cents. From here to there, I get paid another 20 cents. So it's not very exciting to sell the lower calls. So I just have to then consider how much am I paying down here for these 33s? They're $4. I'd like to pay 2. So if I look for something around $2, I'll go the other way. I'll say the 38s, but then I've only got a $4 spread. The 39s is 160, 180. But look at this. See, this is 170, but this is 155. So I'm going to sell the 40s for 155. Would I go to these for 140 for 15 cents more? My target's only 43, so I think I'd stick with that. It's a $7 spread, and it's going to cost net, if I do the 40s, it's going to cost 160 from 4 is 240. So my cost is going to be 240 on the $7 spread, and my upside is not bad. My upside is going to be $4. That's a very nice upside. Nothing to complain about, right? And that's all it is. We're just trying to be logical and pick the right spot. So meanwhile, all right, you're paying 4 minus 160 is 240. You're paying 240 for the spread. So when do you roll? You roll when your short call, when your long call drops to the 240 you paid for the spread, because you still have this value. So let's say that you had originally bought the spread with, let's say you bought the 37.45 spread for 240 a long time ago. Sorry. Well, okay, yeah, even if it is June. So let's say you bought the 37.45 spread a long time ago for 240, and now it's 230 for the 37s. You can get, that's the money you put into the spread was 240, right? So what can you do logically? You can roll you can cash your 240 on the 37s, and you can roll to anything. Now you've basically taken your cash out of the trade. Now, so then you can roll to whatever is 240 in January, but keep in mind you haven't done anything with the short 40s yet, and they cost $1.60 to buy them back. You don't want to buy them back if you can avoid it, but you better cover them. So then you can move to another spread. Now, don't forget, the only reason that they expired, that they were going down on you, is because the S&P was strong. So given the S&P has been much stronger than you thought, you might want to not go as low because you're not as sure the S&P is going to go down, or maybe it's more overextended than you thought. You have to make that decision. I would probably still stick in the same kind of logic, but I don't want to spend too much money. I'm bearing in mind that my shorts are the 40s. So if I can go 36, 35, because I'll pay, if this is going to be 40 cents and this is going to be 70 cents, that's worth it. If this is 70 cents and that's not worth it, there's 50 or more. So the 35s are 475, and I've got 250 to spend. I already know that, so that's easy. So 475 minus 250 is 225, right? So I look for 220. So look at this. So for 225, I can get the 46s. So now, I forgot where I started. So now I can have the 35, or here, it doesn't matter, I mean it's arbitrary, but now I can have the 35-45 bull call spread, an even wider spread. I'm really well covering my June short call, sorry. I'm covering my June short calls, and I've got a brand new spread that gives me another 6 months of protection. So that's my rolling decision. So the thing is, you're initially putting money up front to buy a spread, but you can then reuse that money over and over again for that. Now, you bought yourself more protection for the same amount of money, but you also have to set a stop because you're fully covered. If you're rolling from, if you have 20 short here and you buy 20 longs, you really want to put a stop on 10 of these at like $1.75 or $1.80 and put another stop on the other 10 at $2. So your worst case is you're spending $2 more. But the only reason you would spend it is if this is going into the money. And if this is going into the money, then your spread is going to be, obviously, since you're buying the 35s, then your spread will be in the money, and you're only spending the money you were already gaining on the hedge. But it's a wider hedge, so it makes up for it. So I hope that was clear. It's a lot of what ifs, unfortunately, because if you're looking ahead like that, you have to start thinking, well, it's like chess, like all these different things can happen in the next move, and then, well, what about the move after that? Well, in the move after that, now you've got another 50 times more different things that can happen. So every time you look another step ahead, you're really increasing how many different possible things can happen to you. All right, so Bird says, Apple, do you see a pullback on Apple, and if so, to what price? Well, I love these. I love questions about the future. It's so exciting. Look, so I see a technical pullback because we hit our goal of 172. We were looking to get to actually 171 something, I think was where we were looking for. So they were was it 171, 60? I forgot. I wrote a whole series up on it. Anyway, I guess I can do the whole thing from scratch. It was 230 to was it 150? Was 80, right? Which means that a weak bounce would be 20%, so times 0.2 is 16, plus 150 is 166. So your first bounce is 166. Your second bounce is 16 more, is 182. So here, 182 is a strong bounce. All right, that's looking at the big picture. There's the short, we get numbers for the small picture too, but the small picture numbers are confirming a bullish breakout, so we should look at the bigger picture now. And 172.50. There's a different segment of apples that we were watching, but I forgot where it was. Anywho, oh yeah, wait. I did this yesterday, didn't I? Why do you guys do this to me? It's like I just did this yesterday, and you're asking a question now. I swear it's in here. If it wasn't yesterday, it was over the weekend. But I remember sitting there with an apple chart. So let's see. So, because of course, it wouldn't be good if you had to do it. It would be no good. So I'm going to go and look and find Apple in the post. And I'll see if I actually wrote up the chart. Not there. Not there. Here. Oh, that's something exciting looking. No, but that's not the one. Okay, here's Pat. Nope, that's not it either. It was a weekend. I think it was Monday. Okay, so it's not there. So let's go to the next day. And then I'll look at the next day. So I have to do the same thing you would have to do, except I'm doing it for you. Now we're going to Monday. And I say, Control Find Apple. And here's me talking about Apple and Twitter. That's not important. Next. Aha. Oh, look, Apple right on track. So here's when I talk to Batman about this. And we had that conversation. We did that and that and that and then that and that. And then I think I drew lines. Yes, there they are. See, I knew I did it. And then I came up with this whole chart. So this entire huge giant comment from Monday was all about Apple and where it moves and where it can move and what it will do and so on and so forth. So anyway, we decided the 162.50 line was key and that we would expect to move up. See these lines? Look where we is 171.40. Then the next line was in fact 171 was the line, 171. These, oh, by the way, when you do these Fibonacci lines on stock charts, they're annoying because you can't make an exact number. It just comes out where it comes out. So unfortunately, I couldn't make it exactly 170. This should be exactly 180. So for us to break out of the consolidating on the low end series, we have to get over 180 basically. So but as you see, we're hitting these numbers. We're here, we're 170. I think we're right about 173 right now. Is that correct? I don't know where we are. Okay, so we're right about 173 now. So it's 171, 173, then it's free range until we get over 180. So we should consolidate up here until 180 and then back. But meanwhile, can we get a retracement? Absolutely. It would be actually kind of healthy. So we had a big pop. We've come from 155 to 171 or 172 or whatever we're at. So let's say we made it to here, to 173. So you have this big pop to 173 from 155. So then it's very simple. You sit there and go, okay, so 173 minus 155 is an 18-point move times 0.2. So $3.60 retracements. So minus 173 is 169.40. And minus, what was it, 360? So minus 3, oh no, it'd be plus 3.6, 165.80. So basically, right about here, 166 is where you're going to expect to hold up on a pullback. And if that holds up, and notice that happens to be the 200-day moving average. It's not complicated. By the time we fall to 166, if we fall, the 200-day moving average should start curving up because we're still above the 200-day moving average. So every day we're above it, we're pulling it higher. The 50-day is clearly rushing up to meet us. And that's going to form a bullish cross over here, and it's going to pierce the 200-day moving average. The 200-day moving average will start to curve up. That will make it very, very bouncy when we hit either one of those as they start turning higher. So we have a nice little consolidation here, and then we run the wave up the thing again, just like Apple usually does in its long-term configurations, which we can look at now here. Runs up the 200-day moving average, usually on the positive side of it. So that's the future. MU big pop, do you think this will hold up here north of 40? Yeah, I think they've been so stupidly underpriced. So I'm not looking to take profits yet. I think 45 though. I think you know, again, it's the same kind of thing. I think 45. I don't think the market's that strong overall. In fact, the Dow's red again. Trump nominates David Malpass for the World Bank president. Oh God. Okay, that's more. This is horrifying. Okay, they're just taking these. This is how the oligarchs took over Russia, you know. It's the same bullshit. They just keep putting in his buddies into positions of power. Anyway, all right. Well, we'll worry about that later. So where were we? Oh yeah. So you know, 45. First of all, 45 is a huge run. From 28 to 45 is pretty much 100% move up. So at 100% move up, you sure as hell expect a pause of some kind. So certainly around here, I would certainly want to cover up a little bit. I'm not sure how exposed our micron positions are. I know it was something we talked about today. Let's see what else we talked about. Oil inventories, not exciting. Crude had a small build, but less than expected. Gasoline had a small build, less than expected. Distillates had a nice draw and more than expected. So on the whole, it's a good report, and oil prices went up since then, but not tremendously. Gasoline actually did the best. Natural gas cannot get over this thing. It's like bipping along this range, but I'm hoping it's going to break out soon. MU, okay, here we go. So our micron positions in the long-term portfolio, we actually are fully covered, so we don't have anything to do in the long-term portfolio. We've got the 35-55 spread. It's a bit aggressive, and we didn't apparently roll it down because we have been burned before on them, so we're just watching to see if they would finally break out. So our target is quite a bit higher than here long-term. We sold the 55 calls, and this is perfect. We sold the 55 calls. We sold the 42 puts. This is a perfect trade. Every target here is proper. That thing's gonna make a freaking fortune. We got 40 of them. From, if this comes in, it's 40 times 20 is $80,000, and all we spent is nothing. 48 minus 26 is 22. Minus 17 is $5,000. $5,000 on an $80,000 spread. I'm going to nail it. I mean, honestly, it was only a $500,000 portfolio. So think about that, right? We took $5,000 out of $500,000, and we make $75,000 profit on that. That right there is 15% of the entire portfolio that we made on one trade. I mean, options are freaking amazing. It's so great. I don't understand. People always like buying these high flying things and chasing after stuff. And I'm like, just buy something good that got beaten down. It's such a simple concept. Just buy a value stock, sell the puts, buy a bull spread, sell some calls, make some money in between while you're waiting, and everything is hunky-dory. It's not a complicated thing. This one trade is 15% of the entire portfolio in profits, or will be if it hits it anyway. In the OOP, and by the way, I said in the last review, I said still good for a new trade, right? And I'm saying this is what I mean when I say still good for a new trade, because it's hard to see. But in the last one, it was 26 minus 7 minus 11 minus 4 is minus 12 about, so about 14,000. There's the actual number. It's 14,747. And now it's $25,000. That's in 3 weeks. It made $10,000. I mean, 66% in 3 weeks this trade. And it's the same thing. It's You simply stick with the value stocks and wait until they come back in fashion. It takes a long time. It's tedious. It's not an immediate reward, but find a hobby, do something else. Don't stare at the goddamn screen all day long. And look how conservative we are on this one. Our target's only 38. We're already above target. We're in the money. This trade was 30 minus 10 minus 7 is about $13,000, and it's going to pay. Oh, it's not even fully covered. It's going to pay 25 plus 13, so it's going to pay $26,000. So it's going to be 100%. Plus, if we're over 38, and that's why we're partially covered. If we're over 38, look how low that is. $25 puts we sold. Holy crap! If it's over 38, I find these hilarious sometimes. We're going to make more than $26,000. We're going to make so if it goes to 48, we're bidding 55 here. If it goes to 48, we'll make a bonus $10,000. And that's in a $100,000 portfolio, so that's 20-something% of that portfolio on one trade. But more importantly, I mean, $10,000, 10% of the portfolio in 3 weeks. This is not this is the same trade. The $25 puts were $13. That's insane. Oh, no, these aren't puts. These are called, sorry, the puts. No, these are $25. Sorry, the $25 puts were $3. But Micron was 33 at the time. Now it's 41. But at 33, I mean, still it's free money. Unless you really think Micron is a terrible company, in which case you shouldn't be playing it. And at the time, the spread was 13. It was $6, and now the spread is $8. Not a big difference. Doesn't take much to make $10,000, frankly. It's not a big change, but it's a big change for your on the bottom line because we got 20 of them, and I'm only partly covered. That's another reason. So do we think it'll hold up north of 40? Yeah, I do, but I would still sell something at 45. I'd still take we're not going to, so we already did. We already sold 42s here. In this portfolio, I don't think I want to play games that we're deeply in the money. It's so selling calls is only risk and no reward. Although we have some uncovered. All right, yes, I would sell 5. So if we hit 45, I would certainly cover 5. Just because it's the right thing to do. If I sell 5 2020 $45 calls at 45 and I get $5 for them or something like that, yeah, why not? I'll take $5,000 and put it in our pocket. I like putting money in our pocket. And by the way, this is something a lot of you rich guys lose track of. I noticed that because a lot of the richer clients and guys in my hedge fund and stuff like that, they tend, when you have millions of dollars, you tend to forget that when you make 5,000 here and 5,000 there and 10,000 here and 10,000 there, it adds up. If you keep passing on these opportunities to drop some money into your portfolio, before you know it, you could have made another $500,000 over the course of the year. If you got if you have like a long-term portfolio like we do, where you have 50, 60 positions, and you pass up making $5,000 40 times, that's $250,000 you passed up. It's not nothing. It seems like nothing because you kind of, you look at trades that make you like these trades that make you 20,000 here, 40,000 there, 50,000 there. You have all these trades making all this money. You say, oh, I don't want to take a risk for $5,000 and it could become a headache. But it's your job to have that headache. If you're going to be a serious trader, you have to take those things. You need to sell. You need to hedge your bets you need to hedge your hedges and hedge your hedges. You should always be looking for a way to generate some cash in a semi-safe manner just in case you're wrong. Because there's so many opportunities to do it, and over the course of the year, if you have 50 positions, you will have at least 25 opportunities, probably 50 opportunities, though, to sell something against them. And the something you sell against them is going to be a couple of percent each. And when you sell a couple of percent in 50 positions, that's 100%. It's a lot. It's not nothing. It's nothing to scoff at. And I see it a lot. I'm surprised how often I see it when I talk to people about what they're doing in their portfolios. It really is not something you should ignore. Now, if you don't have time or whatever, you set and forget. There's different things. If I'm talking about if you're trading for a living. If you're busy, if you're a CEO of a company and you're making money on that, and your portfolio is sitting around making 25, 30% because you're not paying attention to it, fine. So what? That's not your job. But if it's your job, you should be squeezing that extra 10% out of your portfolio. It's stupid not to. So that's what I think about that. Dow is down again. We're just saying Apple was at 174, 175, whatever. I mean, yeah, it's going to go up and down. It's not going to go in a straight line up. So it's going to be what it'll be at any given time. Do we have it? Here it is. I mean, look at this. Look at that spike. See, it was there. Look where it was in. Where were we? When was this happening? That was on Monday. Nobody's paying attention. Yeah, so today it spiked up to about 175. But look, 175, obviously any kind of number like that is going to be hard for it to break on the first try. It's the question of what happens next. So we'll just have to watch and see how it behaves. But there's nothing bad about this pullback. It's just consolidating. It's got to consolidate to do a proper breakout of 175. And again, don't forget, you're talking about a trillion or 800 billion, whatever the hell they are now. There's $1 trillion stock. So all these moves require a tremendous. You can have a short-term move like this, but unless it's immediately backed up by massive amounts of money coming in at that price, it's going to drop right back. Any move is going to be short-lived in this situation because you've got $1 trillion stocks. Unless something actually makes a lot of people think that the stock should be trading at a different price, it's going to keep doing what it does. All right, so things are coming down a little bit, but not too much. This one's active because we fell back below 1520, but we're not below 300 here, so you can still short that if we cross below. You can short this below 25, and this guy already fell below 7,000 line, so he became active. So those are our shorts at the moment. And it's the same lines we've been talking about all week. There's nothing special going on here. So that was our Micron trade. And again, I want to say when we do these reviews, because it's the word subtle. I don't want to say subtle, but kind of. I mean, where the hell is it? Let me hold it. I keep changing things. Oh, that's because Bernie made me look for this stupid thing. That's right. The Apple level. Let's see. But when we do these things, Control F, new. So when I say still good for a new trade, all right. So like David Buster's play, and obviously they're not all going to pay off in 5 minutes when I say something, and that's silly, but. These are your opportunities. If you're behind, if you want looking for things, look for that. Look for me saying it's still good for a new trade. And frankly, this wasn't that good for a new trade. They're all over the place, but they're fine. Where are we? And I say it a lot. New trade, right? FCX, good for a new trade. HRB, good for a new trade. LB, good for a new trade. MU, good for a new trade. NAK, didn't say new trade. It said new. BBBY, good for a new trade. Bed Bath & Beyond. Caesar, brand new and doing well. That's not good for a new trade. It's brand new and doing well. They kicked up fast. Are they still doing good? Yeah, they're going to come up, see what they're doing. They're consolidating, trying to break out. They're getting ready to break up or make a run at the 200-day moving average. Big move, $6 to $9. Very nice. Where were we? Delta Airlines, good for a new trade. Ford, good for a new trade. Gold, good for a new trade. That's the old ABX. Goldman Sachs, Still has a new trade spell, it's not the same thing. HRB, great for a new trade. That's twice I said that one. IMAX, good for a new trade. How are they doing? They should be doing good. Yeah, they are. Okay, they're popping. Macy's good for a new trade. I think Macy's is doing good. Take a look at that one. Macy's stupidly underpriced stock. Oh, no, still languishing, so still good for a new trade. And I mean, never tell me they're on, never tell me we don't have trades. NYCB still good for a new trade. PISA is new, different kind of news. LB new puts, not important. Play, fairly new position, good for a new trade. Do we cycle backwards? It's no, it's the same trade, another portfolio. FCX, LB, HRB. Are these the same ones? MU, good for a new trade. Yeah, these are the same ones. Okay, anyway, I think. But you get the idea. So, I mean, when we have a review, you can always go to the review columns. One of the best things about the reviews, you can always go to the review thing and say, hey, look at that. And also, when we make a big adjustment, obviously the adjustment is a new trade. So, we did a whole bunch of stuff with Apple, but effectively you could just jump in that as a brand new trade. When we're changing, when we change the spread and we change the puts and we change the short calls, it's a new trade. And we're not doing it because we don't like it. We're doing it because we think it's going to work out in the end. So those are new trades too. I don't call those new trades, but I say, but when I say good as a new trade, I mean whatever's sitting there could be used right now still as a new trade. Often they're losers. I don't know what FCX looks like, but let's see. FCX, not in this portfolio. What are you, the LTP? There it is, FCX. So yeah, basically it's a net loss or a tiny net loss on the trade. And we're looking at, it's at 12 now, and we're looking at the 10-17 spread with the short 12 puts. So the puts are right where FCX is now, and you can still get 255 for those. The spread is still, what is that, like 240? So the spread is about 245, and it's a $7 spread. Nothing wrong with that trade. In practical matters, it's 7,200 minus that. It's about $2,400, and the potential payoff on this, we're actually even a little bullish because we only took 20 of the shorts, but the potential payoff here, even at 17, is, I don't know, 14,000 plus another 5 is 17.5. So 17.5, and what I say we spent on it, $2,400. So $2,400 becomes 17.5 if we hit our targets. And again, it's a $100,000 portfolio. The profit is 15% of the portfolio on this trade. So yeah, I like it. And what's my risk? My risk is owning 1,500 shares of FCX at 12. So about $18,000 worth of FCX is my downside, owning it. But it's not really a downside because, where is my thing? Oh no, I don't have my my banking thing. What happened to it? Shoot. Oh well, we'll look on Yahoo. All right. I don't have my my detailed program. FCX, and again, this is a cyclical stock. That's why I did want to look it up on that. What is that thing called? Stockopedia. Let's go find one of those. So if we look at Freeport on the Stockopedia, okay, first of all, I think it's a good play on gold and gold going up. So it's another miner basically. They do copper and gold, and I think copper also, we do the trade deal with China, and copper should shoot back up. They're good for, well, this projection sucks, but generally they're good for a couple of billion a year, but they also have cyclical. They can go through a down cycle and write things off and so on and so forth. But they just did that. I don't think they're going to do it again in the near future. Although I'm not sure what this is. I mean, I didn't know that they had these negative estimates like that down the road. Still, the whole company is only $17 billion. And last year they made $2 billion, and this year they're making $2 billion. And I don't know if this is true, but it's a great PE at that. And even at 17 billion, that's a 30 times earnings. It's not that bad as long as it's not going to continue into 2020. So I will have to look at that a little more closely. But I do think that SCX long term, because we play SCX all the time when they're down. Long term, they're good to have when they're low. I don't know what that's about, though. I don't know why they have such a low estimate there. FCX. But as you can see, over time, this has been a very successful area for us to get in. And in fact, here I was at the money show in New York, and I was banging the table. This is my presentation was on FCX and why people should buy it when it was at $5. So the trade we made there did phenomenally well. So here we're buying it at $10 because you don't usually expect 5, and if it goes to 5, I'd be freaking happy to double down. But we're likely going to be able to hit our goals. We'll get to we'll get to $17, make all our money, so on and so forth. But these are the kind of places you look for. It's like it's cyclical stock. This is the bottom of the cycle. It does go down to $5. Usually it holds around 10 over time. Then it goes to 20 or whatever in case prices go crazy. If we have a big trade deal with China, let's say we have a big trade deal with China, because China has already offered to purposely buy an extra $300 billion worth of goods from the US to fix the trade gap. You guys have heard that, right? So China said, okay, I tell you what, here's what we're willing to do. We're willing to purposely divert $300 billion to buy US goods for import. Now, what kind of goods are they going to buy? They're not going to buy our iPods. They already have our iPods. They can make them themselves. They're not going to buy sweaters. They know how to make sweaters. They're not going to buy sneakers. They make sneakers. They're not going to do that. But they are going to buy commodities. They're going to buy a ton of oil. They're going to buy a ton of resources. They're going to buy copper. They're going to buy steel. They're going to buy things they need where we're not uncompetitive in our pricing. They're going to buy a ton of natural gas. They're going to buy a lot of services. They're going to have IBM come in there and do their computer stuff and whatever. So in other words, they'll buy a lot of services, they'll buy a lot of commodities, those things will go up. Suddenly, if China suddenly starts demanding plus 10% of our commodities, what's going to happen to commodity prices? So then you have to wait and see. This is why I pay attention to politics. Everybody says, they get tired of politics. It's like, you got to think of where everybody is. So China's putting that out as an olive branch. Trump needs a win. That's a pretty good win. Okay, having China promise to buy an extra $300 billion worth of goods to balance out trade over 5 years or something like that, or whatever they're doing, is a win. And then you just have to figure out what sectors are going to benefit. So will Trump go for that? I think when push comes to shove, if the State of the Union address doesn't lift his approval rating significantly, he's going to feel a lot of pressure because he doesn't have many cards left to play. His wall's not getting built. At best, he'll get a weak compromise on the wall. That's not going to make him look better. So his biggest chance to look presidential and look like he's accomplishing something is to make this deal with China. And then you think, okay, what else would China give up? And is China going to change their internal systems of how they govern corporations? Is China going to change their patent systems? Is China going to change that you have to have some Chinese ownership? Look, China doesn't want their country taken over. That's why they have this 50% ownership rule. Their economy 10 years ago was 1/4 the size of our economy. If they didn't have a rule that you had to, a company coming in had to have a 50% partnership with Chinese people, then basically all these companies like McDonald's and whatever would just be all over China, and there'd be no Chinese ownership, and all the money would be sucked out of China, and it would look like every town in America where the big conglomerates come in and suck all the money out and leave the town dry. They don't want that. They're not stupid, and they're not gonna give that up. They'd rather not trade with us at all than do that. So you have to think, how much does Trump need to win? What is China willing to offer? China has said what they're willing to offer. They're probably not going to change it. And that's probably going to be the deal. And Trump needs to say he's got a deal. I don't think, I hope, I don't say I don't think, because I think he wants the money. I think he wants that tariff money. But I hope that he's going to want to win more, and he's going to try to make a deal with China. Because he needs to win. He needs something, because, you know, he's people get indicted left and right, and he needs something that's going to say, I'm, you know, you don't want to lose me, I'm good for the country or something. I mean, who knows what's in his mind. I don't know how many people still think that, but he needs some talking points, and this would be a good one. So anyway, so I think that Freeport is one of the companies that will benefit tremendously from increased trade with China if it all works out. Now Murray says, let's see, Joe, do you think this will be north of 45 in April? No, April's way too soon. I have long calls on Joe. No, we're gonna end up rolling. I mean, it's a little short. Portfolio has March 38th. So Joe, where is Joe? Joe is the coffee ETF. Do we still have that? Surprised. Oh, here. I didn't realize it was at 30. Oh, yeah, I think it's going to hold this. I think it's going to go higher. I think, and again, my premise on coffee is that coffee is a fragile crop, and climate change is unpredictable. And therefore, you know, you have a polar vortex, you have this, you have that. But in the summer, there'll be things too. There'll be droughts, there'll be hurricanes, there'll be floods. You know, it doesn't take much to disrupt coffee production. And all we need is one good disruption, and it can spike up tremendously. So I think this is a very realistic price for coffee right now. I think it should go higher from here, not lower. This is an ETF. They split. These things are kind of meaningless. Can you show splits? Isn't there a thing that shows splits? Line, draw, no, indicators. Split. I swear there's a thing that says split somewhere. Settings. Nope. I don't know. I think there was a split. Anyway, it doesn't matter. Whatever. I don't see why it would go down. That's the bottom line. I think that the ETF should hold 38. I don't remember having it though. I don't know what portfolio that would be in. You're saying, oh, there. These March 38s. These are naked March 38s. Oh, they're just leftover things. I'm not even sure I would want to stick with it. It's not in terrible shape, and we're still hoping it would pop higher than, you know, high enough to justify getting out by March. But I don't have high hopes for this. This isn't like a conviction position right now. You know, and I probably would not go back into it because Joe has been very disappointing for us. We bought back the short callers at some point. August. So I'm sorry, it's my mistake. They haven't split apparently. They're just basically catching up. It was horribly disappointing, unless that's been adjusted. But 1 year. Oh yeah. Oh, that happened a long time ago. That's why. So we picked these up in August, and we picked up the 38s, and we paid too much money for them. And they went up here. We shouldn't have been greedy. We could have made some money here, but we didn't. We're still holding on to them, and we're hoping that in March they come back up. In May, we were pretty good. You know, so we'll see what happens. But, you know, basically we bought them for $350, so we need $41.50. So, you know, we're just hoping it hits. But it's certainly not a position I feel very strongly about. It's just something I hope. It's a hope position when hope is not a good strategy in the market. So we talked about Micron, natural gas, the dollar. That was an important discussion. So somebody said something about, Tommy said, where is the dollar going to be? Will be higher. And I said, I think it'll be higher. And here it is going higher. But still around the 96 range. Short term, it depends what Powell says tonight. 7:30 Powell speaking. We'll see what he says. But more dovish comments, which we expect will keep us down because it keeps the dollar weak if we're dovish. And keep it around 96 for the month, which isn't that long. And then longer term, though, look at the long-term chart. See, here's 100. And we peak out there often, and I think that given what's going on in Europe and everything, I think we're going to head back up that way into the summer as the Brexit stuff collapses in March and everything else happens. March 29th is the Brexit deadline. They may delay it. They may back out. Who knows what's going to happen, but if there's a lot of turmoil, the euro is going to drop like a rock and the dollar is going to fly. And that's where we are. And I talked about... Yeah, so look, the dollar's only up 7% while the euro is down 9%. Part of that is because the euro is being kept up because the Swiss are propping up the euro. Canada is weak because of their low oil prices. Australia is weak because of China, and China is pegged to the dollar, so their currency becomes pointless. If the dollar if their currency just follows the dollar, then their currency is meaningless. It has nothing to do with trading. And the UK is out with Brexit and won't get fixed, and that's that. So there's nothing that we see that's going to strengthen versus the dollar, but many things that can weaken compared to the dollar. So therefore, I would certainly bet the dollar would go higher than 96 where it is right now, and it would certainly hold that 96. And that brings us up to webinar time, which is now, which is what we're doing. All right, so that's it. It's really not a very exciting day, unfortunately. There's not a lot going on. Let's see if there's any actual news. Where is that thing? Go to webinar, free court. So we go to Seeking Alpha and see what the market news is. Boeing, market demand supports higher production. Well, sure it does. They got a huge back order. They build 52 jets a month. That's always, I love these statistics. I always like to know this stuff. They want to go to 57. That's right. That's a 10% increase in production and earnings for Boeing, but I just can't play Boeing. They're so high. General Motors sees EV profits in a few years. Funny, Tesla. See if Tesla sees any EV profits in a few years. Microsoft anti-office ad campaign. I don't know what that means. Antitrust fail. MTN, well, how are they doing? I like Vail. Vail is Vail Ski Resorts, and they own a whole bunch of resorts around the country, not just Vail. They're very into the real estate part, and they go up and down sometimes for dumb reasons. So when they're down, I kind of like to take a look at them. They are not down at all. Holy shit. Wow, 202. We used to play them at like crazy. The last time we owned Vail, that drives me nuts when that happens. I mean, we haven't played Vail in years, but it was back in the crisis we played them, and they were one I liked a lot. But this is crazy. I didn't know they got to 202. Yeah, 50. That's about right. This is when we used to play them. I think when they went from 50 to like 25, and I was like, oh, this is a great start. Let's buy it. And then we got to play 50 again, and we're like, yeah, fantastic. It's a double. So we never really paid attention after that. Wow. That's crazy, guys. So quick look at what their numbers are. MTN. Summary, $8 billion. That's too high. No, that's you paying 20 times last year's earnings. Quarterly, ish, nah. I mean, they're probably investing it for good reason and so on and so forth, but I don't know. It looks like they could earn. See what happened here. Why did they go from 844 to 211? They must have sold some significant something. I don't know. I don't see it. That's a shame. I really did like them, but it seems to me they're not going to be hitting those numbers again. So through the middle of the year, they were fine, but then whatever they did, they must have sold off some huge chunk of their operations or something. I don't know what they did, but Again, it's like without research, I wouldn't touch them, but that just, it just rubs me the wrong way when we came in, we got out at 50 and they're at 202 now. It's another one that I'm saying where you see some of these stocks are just so crazy because who in their right mind is going to pay 28 times earnings for effectively a REIT? There's a lot of the S&P is like this. A lot of the S&P is based on just these incredible valuations for things that never should have that kind of valuation. And that's where really the danger is in the market still. Anyway, all right, so that's good. What else is happening? U.S. box office down 16% in January. Uh-oh. They say the government is shut down. That's an interesting reason. The freezing cold weather, that's true. It's not really kind of whether you want to hang out at the movies. You know, especially with your kids, because the movie is like a hanging out thing, and they tend to like congregate outside and whatever, or go walk from place to place. So it can make it kind of miserable when that goes on. So we will see IMAX. I'll mention IMAX is like a stock that matters, but IMAX gets affected by that too. So Vail adds an Epic Pass. Hey, what's an Epic Pass? Sun Valley Resort is being added to the Epic Pass. Oh, I see. Okay, yes. Private equity. Nothing actionable, folks. Sorry, nothing too exciting here. Huh. Nope. So really, so I mean, all we can do is wait to see what what's his face says, Powell. So we'll see what Powell has to say today. But there's nothing very exciting going on. There's nothing significant. The earnings are coming in decently so far, but of course the bigger companies tend to report first because they're more organized. And then the smaller companies come in with their reports, and the smaller companies are probably being more adversely impacted by things like the government shutdown and also the consumers pulling back and so on and so forth. So that's what we're going to have to watch closely in the next couple of weeks. And the question is, are we going to be able to take these 200-day moving averages and hold them? But the only big catalyst we have right now is Powell. And depending on what Powell says tonight, if he doesn't say enough or if he says something that goes the other way, because all he has to do tonight is say, you know what, we still do want to do a couple of hikes this year. You know, it's not, we don't want to do none, we want to do a couple. Boom. We could go back to where we were last January with that giant pull down in the market. So, you know, make sure you do have some hedges in there in our short-term portfolio. We got some big ones. I don't believe I changed them. I believe they are what they are. But we have 200 2020 SQQ 1530 threads. We've got, when we short March 22 calls, we're quite a ways away from there, so I'm not too worried about it. We're also short some June 17 calls, and we're quite a way away from there. So we're pretty, I'd say we're not super bearish. There's 200 short calls against it, but we'll buy some of those back. In fact, I don't know why we still have these March calls. I guess just out of principle, because the March 22 calls are almost certainly not going to get hit from 12 unless there's a complete meltdown in the market. And even if it is, we're covered. Of course, we don't want to be covered, though. We want to have it back. I think we should close those, though. I think it's kind of silly to keep them open. Then we've got, see these Teslas. We have to fix that. Then there's TZA, where we have 200 of the bull call spreads. We have 300 short April 15 calls. And we're at 1051, and those are 22 cents. We should be buying those back too. Why do we leave these things open? I don't know if we did or we didn't, but I mean, it just seems silly. Let me see. Control F, TZA. Let's buy back 50 short April calls. There's just 70 and makes us much more bearish, and we'll roll out 2020 calls, blah, blah, blah. Okay. That wasn't blue. It should have been. In this case, we're up 81% on the April 15 calls, so buying those back makes us very bearish, and we can roll the 2020 calls to the, oh, I see. So we did. We did move to a much more bearish position on these. We rolled these to the 12 We rolled our long calls to the 12s. We bought back the April calls because it's silly to leave them open like that. And now we've got it. So we have massive protection. I mean, we're not going to get to there if the market dropped 20%. This would go up 60% to 16. Not going to go to 25. So there's just no reason to buy these back. But let's say it was a 16. We roll these down to the 12s. That means these will pay off 4, which would be $80,000. So that's what we have in here. So we have $80,000 worth of protection realistically at 16. Because the market would have to fall 20% for these to go up 60%. You always have to be realistic about your targets, otherwise your hedges don't work. At least we know at 16 we'll get some money out of this thing. And that's why it wasn't hugely necessary to run and buy things back, because see, this is a very tough target to get to, especially by April. That's why they're so cheap now. Anyway, so those are the hedges, and we have less positions. This one's closed, Tesla's closed, XRT's closed, Microsoft, like I said, is closed, but we roll the puts. Celgene was January. Oh, Celgene closed out too. That's another one that we we didn't do good on that though. We ended up, because Celgene came in lower than we wanted it to. But at least the puts expired worthless. And that's where we are. All right. So if anybody has any questions, great. But if not, we're going to be done for the day. I don't believe anybody has any more questions. So we are going to wrap this one up, and we're going to get back to the last little bit of the market, and we're down just a bit, and we'll see what happens tonight after Powell speaks. That's going to be the key for tomorrow, and we'll watch that closely. Oil is fading off there. Gasoline's still holding up good. Natural gas still incredibly disappointing. Gold not having a good time last week. Silver not having a good time last week. Apple 174 is pretty damn good, and the dollar at 96.15. So all in all, nothing is happening. Let's hope it's more exciting next week, all right? Thanks a lot, guys. Have a good day.